All right. So good morning, friends. Well, good morning, Dhyanesh. Good morning, Shankaran. Right. It's 7 in the morning. It's freezing cold out here. I'm sure in your part of India it would be cold as well. Good to see you all awake. The motto of Institute goes Yeh Shapteshu Jagriti. No, while others are sleeping, we are awake. Well, Vishesh, Namaskar. Well, let's start. So now, the topic that we have on hand today is about carry forward and set off of losses. There's a bit of aggregation of income as well, which is taken care of by the first chapter. So I'm not taking it again. Um, think from the perspective of an assessee. When you think from the perspective of an assessee, you would find logic to a particular section. Once you find the logic, I bet you won't forget that section. So how do we proceed? Well, we are going to go step by step and in a manner where we understand, where we try to understand logic of each of the provision relating to set off and carry forward. See, understand friends, a person could have income from different sources. And those different sources could be taxable under different heads. So you've got multiple heads. If you go by section 14, you've got 5 heads of income, which I'm sure you have already completed. So you have, you've gone through salaries, you've gone through house property, business profession, capital gains, and other sources. So a large part of your journey, as far as computation is concerned, is almost over. So you have also seen clubbing. But then, a person can have not just income, but also losses. Now, how do you deal with these losses? When I go to section 4 of the Income Tax Act, the original charging provision which you had learned in the first lecture probably, you would know that it has a charge on the total income of the assessee. How do you compute the total income? Well, you aggregate all the heads and thereafter you reduce deductions which are available. But before deducting something, before the deductions under chapter 6A, what you have to do is you also have to set off for losses. Now, set off of losses is, a luxury. Why do I say that? Because if there is no provision, you cannot set off the losses. Only and only if there is a specific provision could you set it off. When you talk of the Income Tax Act, the provisions relating to set off and carry forward of losses are contained in section 70 to section 80. So thankfully, there are only 10 sections which are governing the entire carry forward and set off. But it's not that simple. Fortunately for you, set off arising due to reorganization, like amalgamation, demerger, that's not in your syllabus. So thankfully, it's not very complex, but important from the perspective of examination. See, you might not probably get a complete question on set off, but yes, there could be a small adjustment in a big problem. So unless and until you're aware about the provision, probably you won't be able to deal with that set of problem. And therefore, going through the set of provision is extremely important. Well, what I have divided the chapter into three parts. See, we've got set off of losses, which is governed by section 70 and section 71. Then you've got carry forward of losses, which is governed by different set of sections starting from 71B to 74A. Then there are a few sections which completely bar set off. So no set off is available because of a specific bar on set off of those income. Now you would think, why on earth would we bar set off? If somebody has got income, you should be able to set it off with the losses that he has got. Ideally, in an ideal world, why should anyone not get the benefit of loss that he has incurred while paying income tax? And then, ideal world rarely exists. And logically so, see, not all kinds of losses you want to promote. There are a few activities which the government doesn't want to promote. And therefore, if there is a loss arising from those activities, probably there is a bar on set off. Now, I'm sure these notes would be seen onto the website. You would have these notes available with you. When, when you talk of speculative activity, when you talk of wagering agreements, now those are not which the government wants to promote. And therefore, if you incur any loss while you are speculating or while you are indulging into wagering contracts like horse races, crosswords, or lotteries, yeah, the government is reluctant in giving you set off for the losses you have incurred on such windfall activities. Similarly, there are a few income which already get a lot of concession. So if you have income from a source which has been granted concession already, in such case also losses arising from such concessional activity may not be set off against an income which doesn't have that concession. And therefore you have got some restriction on long-term capital loss. You've got some restriction on specified businesses. So these restrictions are fairly logical. As we proceed through, I'll just explain you how those restrictions are quite logical, and therefore, you'll remember the provision once you understand the logic of it. First and the foremost, what we do is we deal with section 70. Section 70 deals with inter-source adjustment or the intra-head set off. See, under one particular head, you can have multiple sources. So like from house property, you could have one house which is let out and the other house could be self-occupied. So ultimately, you've got two sources, isn't it? So there could be house one and house two. Both of them could be let out, say, for instance. Now, if both of them are let out, one house could have loss due to interest. There is a housing loan taken for house one, and therefore there is a loss arising on income out of that house. However, there is an income from house two. Now, both could be set off to find out the net income under income from house property. Now, you would say, what is so great about it? It is fairly logical that, house one and house two, loss in one, profit in another, I should be able to set off. And that is so. It is very simple. When it comes down to three heads of income, you've got income from house property, you've got PGBP and IFOS, that is other sources. With these three heads, well, there is a loss from source A could be set off against source B. Although under PGBP, we have got two exceptions. I'll come down to those exceptions, but for the time being, understand these could be set off very easily. Somebody might think, why don't we have salary? Salary is not covered. Well, salary is not covered because rarely do we have loss under the head salary. I couldn't think of a situation where you would have a loss under the head salary, except for a very, very ultra technical situation where a person has got a salary of 50,000 rupees and he claims a deduction under chapter, under section 16 IA, and also he pays tax on employment. At the most, his loss could be probably 2,500, but then well, there could be no loss practically under salary, and therefore salary is not covered. So none of the sections relating to set off cover salary, therefore. See, how does section 70 go? It says except as otherwise provided. So if there is a specific section, section 70 would not apply. Whether net result in respect of any source falling under any head. So we are talking of a source falling within a head. And therefore, either I call it as inter-source set off or intra-head set off, other than capital gain. See, important. Capital gain throughout the set of provisions have been given special treatment. As we go proceed further, you'll learn. So if any source results in a loss, so like I was talking of, business one has got loss, business two has got profit. Now, the assessee shall be entitled to set off such losses against income from any source under the same head. So this is quite clear. This is very simple, easy to understand, except for capital gain is what they say. Now, what happens with capital gain? With capital gain, you've got two kinds of capital gain. You've got short-term capital gain as well as long-term capital gain, isn't it? You've got STCG and LTCG. Now, let me explain you the logic. See what happens with LTCG, you get a host of benefit. Number one benefit that you get is indexation. Number two, what you get is a concessional rate of tax at the rate of 20%. With indexation, you got to pay 20% of the tax. So you have already had a bit of concession. Once you already have concession in place, I might not allow you the set off against any other, the loss arising from this activity, which is already undergone concession, should not be allowed as set off against an activity which doesn't have that concession. So quite logical, friends, you understand. See what happens is STCG is taxable at regular rate. LTCG is already indexed and it is taxable at 20%. Now, the assessee would have an unfair advantage if he sets off losses which are taxable at 20% with a regular taxable source. And therefore, the long-term capital loss can be set off only against long-term capital gain. See, once you understand the logic, well, the provision is something you will not forget. Therefore, long-term capital loss only against long-term capital gain. But when it comes down to short-term capital loss, well, you can set it off against both the short-term capital gain as well as long-term capital gain. Because anyway, which, this was taxable at 30%. Had this been gain, it would have been taxable at 30%. Now I'm setting off a loss of 30% against an activity which is taxable at 20%, beneficial to the government. And therefore, quite logically, what they've allowed is short-term capital gain, short-term capital loss can be set off against both the short-term capital gain as well as long-term capital gain. Long-term capital loss could be set off only against the long-term capital gain. While we started the section with an exception clause or a saving clause wherein we said that except as otherwise provided. So what is provided? What are the exceptions to this intra-head adjustment? The exception number one is relating to 73.1. Section 73.1 provides for losses in speculation business. They cannot be set off against regular business activity. So if you are indulging into speculative activity or speculative business, and if there is any loss that arises on that speculation, it cannot be set off. So though, while we talked of PGBP, I told you that there are two exceptions. Number one is speculation. So speculative activity is distinct. I want you to go back to section 28. explanation 2 of section 28. See, I'll show you. We'll try. See, what is speculation? First, we'll just see what is speculation. What is speculation? Well, when you talk of speculation, it is dealt by section 43.5. So 43.5 defines what is speculation. Just a second. See, first, if you go by explanation 2 of section 28, you would find that speculative transactions are treated as distinct activity. So my business, speculative business, would be treated as a distinct activity. Only because of explanation 2 to section 28, we treat it as distinct from normal business. So once it is treated as distinct, you have to arrive at the profits of speculative transaction distinctly. So you may not maintain separate books of accounts. It is not required. But whatever profit or gain that arises out of the speculative transaction got to be treated distinctly. Then they say that speculative transaction means a transaction in which a contract for purchase or sale of any commodity, including stocks and shares, are periodically or ultimately settled otherwise than by way of an actual delivery. So simple, I guess all of you know this. Wherever there is a contract where the actual delivery of goods, commodities, or stocks and shares don't take place, those activities are treated as speculative. There are a few exceptions though. So exceptions where speculative the delivery doesn't take place, yet a transaction is not treated as speculative. If you two striking transactions relating to derivatives, where there is a specific exception that those derivative transactions would not be treated as speculative. One is derivatives relating to futures and options in a stock market. So if you are indulging into derivative transaction in stock market where you pay STT on those transactions, well, those transactions are not treated as speculative. Ultimate delivery doesn't take place in those transactions also, but yet it is not treated as speculative. Similarly, commodity transaction where you pay the commodities transaction tax, even those transactions are not treated as speculative, despite the fact that the ultimate delivery of commodity doesn't take place. Similarly, if you have entered into a hedging transaction, well, again, it is treated as non-speculative. So there could be a situation wherein, you have got losses from futures and options in shares, and they would give you an additional information that the ultimate delivery did not take place. Well, futures and options, as far as shares are concerned, and if you are trading through recognized stock exchange, those are not treated as speculative, despite the fact delivery has not taken place. So section 73.1 leads to a specific, give me a second. We'll go to section 73.1 says specifically that the loss arising from speculative business cannot be set off against another non-speculative business. So it could be set off against only speculative business. Speculation loss against speculation profit, possible. Speculation loss against non-speculative profit, not possible. The idea is simple. We don't want to encourage speculation, isn't it? And therefore, speculative loss can be set off only against speculative business. Well, non-speculation loss, can it be set off against speculative profit? The answer is yes. If you have incurred any non-speculative loss, that loss can be set off against speculative profits. Going further, the second exception under the head of business, the second exception is set off of losses by specified business. Now, these specified business are those covered by section 35 AD of the Act. Now, what is section 35 AD? Again, you will have to, rewind a little bit and go to PGBP, where you have gone through the provisions of Section 35 AD, which want to promote investment in certain sector. See, what has happened in the recent past is we've moved from profit-linked incentive, like the one that was offered under Section 10AA, etc., ATIA, IB. We have moved from profit-linked exemptions to investment-linked exemption. Now, deduction is available under Section 35 AD in respect of investment made for the sector which the government want to promote. When you look at the specified businesses under 35 AD, you'll find that all of those businesses are of national importance. So, like setting up of cold chain facility or setting up of warehouses for agriculture. Don't you think it's very important in Indian context? There is so much of rotting grain, and then there's no supply chain management, and therefore these projects, if the assessee is going to invest in these projects, we under the Income Tax Act are giving them incentives. Now, once you give them incentive, friends, what happens is, historically incentives have always been exploited to the advantage of the assessee, and therefore you need provisions like 73A, wherein what they say is, if there is a loss there is a loss arising out of specified business, you could set it off only against that profit from specified business. So you cannot set off a loss arising from specified business against the profit of non-specified business. That's all. No, ideally, when I think of it, I think this provision is a little harsh, because see, one who is investing should get full benefit. But so be it. We have got Section 73A in place, which says that if you have incurred any loss in a specified business, then that loss shall not be set off. It shall not be set off except against profits from other specified business. Right? Getting this. So you need to have a specified business which is covered by Section 35 AD. Now, what Section 35 AD covers is setting up of cold storage, warehousing facility, laying of cross-country pipeline. Then you've got hotels, a two-star or greater hotel. All of these are specified business. Hospital with a 100-bedded facility. So these are all specified businesses. Loss arising from these specified business cannot be set off against normal business activity. It is more probable that a specified business would have loss in the initial year. The reason is simple. You give them deduction for all the investment that the specified business has made. So for the plant and machinery, for the building, for the equipment, all of them are allowed as deduction in the first year of operation itself. So there is no distinction between capital and revenue as such. And therefore, in the initial years, there would be losses. Now, what a entrepreneur would do, or what an assessee would want, he would want this loss to be set up against his normal business activity to gain more of a mileage. But then what they've done is they've specifically barred it under Section 73A, wherein they say that no, you cannot claim that loss against non-specified business. Then the next set of exception is under income from other sources, wherein they say that loss from activity of owning and maintaining race horses. See, we are talking of only owning and maintaining of race horses. So this is not race horses, those who are betting on race horses. This is about those assessee who are engaged in owning and maintaining race horses. They might not bet on race horses. If they are betting on race horses, well, that is a completely different activity. Here we are concerned with those assessee who, number one, own race horses. Number two, they maintain race horses. These horses would participate in races over which some other people might bet. Now, this activity of owning and maintaining of race horses, OMRH, is treated as distinct insofar as, the loss arising from this activity can be set off only against income arising out of this activity. So you cannot set off losses from OMRH against any other activity. So they've restricted the loss arising from OMRH against profit arising from OMRH alone, right? So you cannot claim a set off arising from OMRH against interest income. That is not possible. So 74A subsection 3 gives a specific bar on inter-head adjustment. So, intra-head adjustment. So, intra-head adjustment, well, as a thumb rule, you can set off one source against another. However, exceptions are capital gain, speculative business, specified business, and OMRH, or the owning and maintaining of racehorses. Well, understand one thing that should be noted here is it is only race horses which is covered and not other animal. So, those who would have watched Kantara, they would have seen a bull race. Now that is not covered over here. What is covered is only race horses. Yes, friends, I hope I'm clear on this. Okay, by the time I go through some of your queries, I would want you to just give me an answer to this MCQ. Okay, I hope this is visible. Okay, I've got a few answers. Okay, Mohammed says it's D. Well, Alok says it's D. Nikita says it's D. Well, yes. Yes, a lot of you got it right. So yes, it is indeed D. Section 70 enables set off under one source of income against another source under the same head, except, so we already saw that specified business, loss arising from specified business can be set off only and only against, profits from specified business. Although it is covered by PGBP, but there is a specific exception. Similarly, you've got speculation loss, which can be set off only against speculative profit, although covered by PGBP, yet a specific exception. Then again, what we dealt with was loss from activity of owning and maintaining racehorses, which could be set off only against profits from OMRH. So yes, all of the above. So you can set off losses from one source with another, except for the three activities. One activity could be long-term capital gains, which can be set off only against long-term capital loss and not against short-term capital gains. So you could have an option relating to that as well. Okay, so yes, a lot of you. Yes, Geet, you're right. Long-term capital loss could also be one of the activities. Well, good, great. Now let's move on to the next set of provisions, section 71. Section C, for while you compute income, the first and the foremost thing that you're going to do is you're going to do a intra-head set off or the inter-source set off. First and the foremost thing is to do a inter-source set off. If anything remains, what you'll do is you'll go for a inter-head set off, inter-head adjustment. So loss under one head set off against another head of income. And if at all, the third step, if at all anything is left even after an inter-head adjustment. So you've got loss which is huge. It does not eat up, it does not eat up the complete income. In that case, that loss which is not set off after inter-head adjustment would be carried over. So that these are the three steps. So we are on to step number 2, where what we are going to do is, after the intra-head adjustment or the inter-source adjustment, we are going ahead with inter-head adjustment. Under the inter-head adjustment, well, section 71 of the Act says that where in any AY, the net result of computation, so the net result of computation under any head, first you need to find out net result of computation under a particular head. That is something you will find out only after you give effect to section 70. Once you have given effect to section 70, if the net result still is a loss, but then, capital gain has got a special treatment. You always remember that capital gain is something very, very unique. So under any head other than capital gain is a loss. In that case, the assessee shall be entitled to have that loss set off against any other head. So if you have got loss under any head of income except for capital gain, that loss could be set off against any other head of income. So, talking simply, you've got a house property loss. Now that house property loss could be set off against salary income. It could be set off against profits and gains of business or profession. It could also be set off against capital gain, and it could also be set off against income from other sources. So house property loss can be set off against any source of income, any other head of income, provided there is no gain, provided you have computed that loss after intra-head adjustment. So house 1, house 2, net result loss. Now that net resulted loss can be set off against salary, PGBP, capital gain, and IFOS. So very, very valuable is house property loss. It could be set off against any other head. So it goes by the word. However, when it comes down to loss arising out of business profession, well, there is a specific provision under under 72, under 71(2)(a), which says that business loss could not be set off against salary. So I'll come to it in a short while. Why there is a bar on setting off business loss against salaries. But for the time being, as a thumb rule, understand that if you've got loss under any head of income, it could be set off against income arising under any other head. So if you've got other sources, loss under other sources, which is again a little unlikely, you can set it off against house property, against salary, against PGBP, and against capital gain. But when it comes down to loss arising from business or profession, you can set it off against house property, you can set it off against capital gain, you can set it off against IFOS, but you could not set it off against salary. Right? Salary, you cannot set it off. Capital gains is one exception, and therefore the provisions relating to capital gain are separately contained in subsection 3. Subsection 3 says, wherein respect of any assessment year, the net result under the head of capital gain is a loss, and the assessee has income under any head, the assessee shall not be entitled to have such loss set off against such income. So it specifically bars capital loss being set off against revenue receipts. See, all other heads deal with regular receipts, regular revenue receipt, whereas capital gain is the only head which is dealing with capital receipt. I would not want a loss arising from my disinvestment activity to be set off against my regular business activity. If that so happens, government might lose out on substantial revenue, and therefore there is a specific bar in setting off losses arising from capital gain against any other head. Similarly, talking of why there is a bar on setting off business losses against salary. The reason is, when you talk of individual category, friends, you would be surprised that out of the 5-6 crore people who are paying taxes, 50% of them are salaried employee. Now, if I were to give advantage to a salaried employee against PGBP, how would I be able to collect taxes? And therefore, what they've done is, lately, although this provision is of a relatively recent origin, they've said, notwithstanding anything contained in subsection 1 or 2, where in a assessment year net result of PGBP is a loss and the assessee has income under the head salaries, the assessee shall not be entitled to have such loss set off, and therefore you do not have the liberty to set off business loss against salaries. Capital loss against any head, business loss against salary, and capital loss against any head. Similarly, post 2018, if I'm not incorrect, house property laws also have got a restriction, and that restriction is, you cannot set off more than 2 lakh rupees of loss. So you cannot set off more than 2 lakh. Otherwise, house property loss was one of the very, very precious losses. It could be set off against any of the heads of income. But then they put in a restriction wherein they said that if you've got loss under the head of house property and the assessee has got income under any other head of income, the assessee shall not be entitled to set off such losses to the extent the amount exceeds 2 lakhs. Do not forget this, friends. There could be a loss exceeding 2 lakh rupees under house property, especially for those assessees who have got home loans which are of a high value. So high value home loans, usually housing is very costly. An assessee could take a crore rupee of loan and he could end up paying 10 lakh rupees as interest. Now, if he's paying 10 lakh rupees of interest, ideally he could have losses under the head of house property. But yet that loss, for the purposes of inter-head adjustment, is going to be restricted at rupees 2 lakhs. Remaining 8 lakh, what happens to remaining 8 lakh? Well, you could carry it over to the next subsequent year for set off. So that is permissible. But what is not permissible, in a particular year, you cannot set off more than 2 lakh rupees of house property loss against any of these heads of income, right? Total 2 lakh rupees maximum is the set off permissible. So inter-head adjustment, very simple. Remember, what is not permissible under inter-source or intra-head is also not permissible under inter-head. So you cannot set off loss arising from specified business against income from other sources. That is not permissible. So what is not permissible under intra-source is also not permissible under inter-head. Are you getting this, friends? Everybody? Well, section 71, very, very clear. You cannot you can set off any loss arising, कोई भी loss हो, which arises out of any head. वो उसको आप क्या कर सकते हो? उसको आप किसी भी head के साथ में set off कर सकते हो. The only exception is, capital gain. Number one, capital loss cannot be set off against any gain. Similarly, business profession, loss arising on business profession cannot be set off against salary. And last, house property loss can be set off only to the extent of 2 lakhs. That's all. Very, very simple. Now, let's move on to the next thing. Once you have completed the intra-source or the intra-head adjustment. You've also done the inter-head adjustment under section 71. And still, if you've got losses, like the one I've discussed, as far as house property is concerned, if I've got a interest on home loan of 10 lakhs, the maximum inter-head adjustment that I can do is of 2 lakhs. So remaining 8 lakh rupees, what happens to that remaining 8 lakh rupees? Well, that remaining 8 lakh rupees would be carried over. Now, the carry forward provisions are contained in section 71B as far as house property is concerned. We'll talk of it. What I want you all to do is just answer me these two simple questions. Okay. Yes. Just go through the question. I hope it's visible. Yes, it is. Yes, Jyoti, I hope I made my point clear as far as section 71 is concerned. थोड़ा सा हिंदी में भी समझा दिया. There's no option E. There are 4 options. Anand? Yeah. Okay, I've got a few answers. Mohammed says it's 5,60,000. Alok says it's 4,65,000. So I've got answer which is B or D. So now a lot of them, no, okay, Harshita says it's A. So Mohammed is quite excited with B. Priyanka says it's A, sorry, B, 4,65,000. So I see a lot of B's there, 4,65,000. And well, indeed, B is the right answer. B is the right answer. See, look, Prajna is employed in a company. Her income from salary is 5,60,000. Loss from let out property. Well, loss under the head of house property could be set off against salary income. The only thing is you cannot set off more than 2 lakh rupees. So, but since it is under 2 lakh rupees, you can set off 65,000 against 5,60,000. Then you've got loss from business. Now, this loss from business could not be set off. I've just told you a little while ago. 71 2A, section 71, subsection 2A gives a specific bar on setting off losses arising from business against salary income. So I'm going to carry forward this. And loss under the head of other sources. Well, this can be set off against salary. So what I could set off is 5,60,000 with 65,000 rupees and 30,000 rupees. So 560 minus 65 minus 30, that would lead me to 4,65,000. Wonderful, friends. Yes. Let me just take you through another small FAQ. Oh, sorry, MCQ. See, could you see this MCQ? Okay. All right. So a lot of answers there. Well, Reno says it's D. Again, Mohammed says it's D. Parthasarthi says it's D. Yes, and it's indeed D. D is the right answer. No loss can be set off against income from salaries, income from house property, income from capital gains. All the losses can be set off. Against salary, you can have house property loss, which could be set off. Against house property, well, you could have loss from under the head of PGBP, you can set it off against house property. Under the head of capital gains, well, if you've got gain under capital gains and if you've got loss under PGBP, that loss under PGBP could be set off against capital gains. But winning from lottery is one such item which you cannot set off against any other loss of any other head cannot be set off against winning from lotteries. The reason is section 58.4. I'll just take you through section 58.4 since all of you have answered it well. It's D. Indeed. But why? See, while we discussed section 70, section 71, we did not come across lotteries. Then why is it that winning from lotteries do not have the advantage of setting off losses? The reason is not section 70 or 71. The reason is section 58, subsection 4. I'll just take you through 58, subsection 4. See what it says. So there is a complete bar on set off. Why there is a complete bar on set off? No set off from winning from lotteries, crossword, etc. Assessee having income chargeable under the head income from other sources. No deduction in respect of any expenditure or allowance in connection with such income shall be allowed under any provisions of the Act. So section 58.4 specifically bars any expenditure to be claimed out of income arising from lotteries or crosswords, etc. These windfall gains, the lotteries, crosswords are windfall gains. And government doesn't want to promote these activities. Therefore, what they say, if you've got income, you are paying me. You got a lottery. Government should also get a lottery. And therefore, they say, no, nothing doing, no loss would be set off against this particular source of income. So in computing the income by way of lotteries, crossword puzzles, races, including horse races. So any kind of race. So it is a bull race or, like you saw in Kantara or, a cock fight. Well, all of them covered over here. Card games or other games of any sort, gambling, betting of whatsoever nature, whether it is legal, illegal, no expenditure shall be allowed and no set off of any loss against these income would be available. Even allowances, there are no allowances that are to be granted. So even if you've got unabsorbed depreciation, we'll come to section 72 where we discussed unabsorbed depreciation. Unabsorbed depreciation has a separate distinct status, but then even that allowance is not available against this income. So by virtue of section 58.4, Well, you cannot set off losses. You cannot set off losses against winning from lotteries. You can set off against income from capital gain. Some of them have answered C. The answer is wrong. You can set off business loss against capital gain. Why not? You cannot set off capital loss against other head. But see, understand the question. The question is no loss can be set off against income from capital gain. So you've got positive income under the head of capital gain. You can set off losses against such capital gains. I hope, Gomti, it's clear to you why not C and why D. Arun, yes, winning from lotteries. Yes, let's move on. Move to the next set, and that is next set of sections which deal with carry forward. So we discussed intra-head, we've discussed inter-head. Now we move on to the carry forward. See, understand 71B and rest of the carry forward provisions are almost similar. Once you understand the structure of 71B, well, the rest of the structure is quite similar. Only the provisions might differ a little bit. See, where the net result under the head of IFHP, that is income from other source, is a loss. So the net result is a loss. Such loss cannot be wholly set off. So if you cannot wholly set off a loss under a particular head against any other head of income as per section 71. So once there is a loss and inter-head adjustments are not possible, in such case, so much of loss as has not been set off. So much of loss as has not been set off shall be subject to the other provision. So everywhere there is a subject to the other provision. There is one provision which is very important. I'll come to it at the end. For carry forward of losses, there's one provision which is extremely important. We'll discuss it at the end. So if you have not been able to set off a loss under a particular head, it shall be carried forward to the following assessment year. So they say, okay, not possible this time, better luck next time. Next year come again, and if you have got a loss in the earlier year, you can set off against income in the current year. So in the subsequent year. So subsequent year, but what if there is no profit in the subsequent year also? It could so happen, isn't it? Now, if there is a loss in this particular year, well, in subsequent year, in every probability, I could incur loss again. When you look at large companies like, Flipkart or Amazon or those startups, they're incurring loss year on year, right? Now, someday they'll earn profit, but then not immediately. So therefore, they've given some cushion to the assessee. They say, okay, you carry it over to the following assessment year, set it off if it is possible. If you could not completely set off, in that case, it would be carried forward to the next assessment year. So next to next. But then how long? You cannot go indefinitely, and therefore they say that not being more than 8 assessment years. So at the most, what you could do is you could carry over for 8 assessment year. So normally you have got 8 assessment year as a thumb rule, but then there are a few items which are sensitive, which the government doesn't want to promote too much. There, this 8 year is replaced by 4 years. Similarly, there are a few items which the government want to promote. In that case, the 8 year is replaced by indefinite time. So you could indefinitely also carry forward a few losses. For the time being, as far as house property is concerned, I hope it is clear to you that it can be carried over. If at all inter-head adjustments are not possible, you could carry over that loss to the subsequent assessment year. And if at all, even in subsequent year, it is not possible for you to set off, you could carry it over to the year after the subsequent assessment year, but not exceeding 8 assessment years. So when it comes down to house property loss arising in 23-24, assessment year 23-24, you could carry it over until 31-32. Sorry, this is not 22-32. A typo there. 2031 to 2032. That is 8 assessment years subsequent to the year in which the loss has arisen. Similarly, then, as a corollary, brought forward losses up to 15-16 alone could be set off. So probably you could get in a problem. You have brought forward loss relating to AY 14-15. Now that this loss of AY 14-15 could not be set off in against house property gains of 23-24. Why? Because 8 years have elapsed. Yes, are you getting this? So as a thumb rule, you first go with intra-head, then inter-head, and if it is not possible, to the subsequent year. However, there is one more thumb rule, and that rule is that this carry forward of loss under the head of house property could be set off only against gains under house property. So you cannot have a inter-head adjustment in the subsequent year. Loss under the head of house property could be set off against gains under the head of house property in the subsequent year. Yes, I hope it's clear now. So that goes without saying. So business profession loss carried over to the subsequent year, well, that loss could be set off only against profits of business profession. Loss of business profession against profit of business profession. Let's move to section 72. Now, this is one of the most used, and since it is one of the most used provision, it is also one of the most litigated provision. Carry forward and set off of business losses, where for any assessment year, the net result under the head of PGBP is a loss. So for any assessment year, there's a loss under the head of business profession, not being loss sustained in speculative business. So not being loss under the head of speculation business. See, understand, speculative business, I told you earlier, it is distinct by virtue of explanation 2 to section 28. So once it is distinct, you have got a distinct provision which is going to deal with speculative business. We are coming to section 73, which is going to deal with speculation business. For the timing, understand that section 72 deals with all businesses other than speculative business. It also doesn't deal with specified businesses, but then for the time being, we still have got speculative business as an exception. Any such loss cannot be or is not wholly set off. So if it could not be set off, there's a loss which could not be set off as per section 71. So much of such loss shall be carried forward. So you are going to carry it over and set off against profits and gains of business or profession in the subsequent assessment year. So you carry it over and set it off only against profits of business or profession. If the loss could not be only set off, it shall be carried over to the following assessment year and so on. So, while you read section 71 subsection 1, 72 subsection 1, you understand that this loss can be carried over indefinitely because it says it shall be carried forward to the following assessment year and so on. So it would go on, you could go on and carry forward it as long as you want. But there is a condition. The condition is no loss shall be carried forward under this section for more than 8 assessment years, immediately succeeding the AY for which the loss was computed. So similar to 71B, but then you can carry it over for only 8 assessment year and set it off against the gains of profits and under income under the head of PGBP. That's all. Are you getting this, friends? So 8 assessment years even for PGBP, normal business activity except for speculative business. Then it says, see this subsection 2 is important here, 72(2), where any allowance or part thereof is under subsection 2 of section 32. Right now, subsection 2 of section 32 deals with unabsorbed depreciation. unabsorbed depreciation. You got to rewind yourself, you got to go back and imagine depreciation, which is governed by section 32. See, depreciation is an allowance. Depreciation is not expense. It is an allowance. It would be granted to you whether you claim it or not. Now, there might be a situation wherein you have got depreciation. Usually in the initial years of business, you've got high amount of depreciation. And therefore, as a result of that depreciation allowance, there could be losses. Now, if those losses are unabsorbed, which is in the nature of depreciation allowance, it could be carried over. So what section 72(2) says, where any allowance of part thereof is under subsection 2 of section 32 or subsection 4 of section 35. Now, section 35 deals with, yes, scientific research, right? So either it is allowance in the nature of depreciation or it is in the nature of scientific research to be carried forward. Effect shall be given to the provisions of this section. See what this particular provision has done. It has created a distinction between unabsorbed depreciation and other business losses. So unabsorbed depreciation is dealt distinctly by the provisions of section 32(2) and not by section 72. So you have got losses arising from PGBP, which you will have to segregate into two parts. One is how much is the unabsorbed depreciation, and the other is how much is other business loss. See, I'll just explain you. Say, for instance, you have got 1 lakh rupees of loss under the head of PGBP. This is loss under the head of PGBP, 1 lakh rupees. And you have got, let's say, while arriving at this 1 lakh rupees of loss, you've got depreciation of rupees 1,20,000, which was debited. Now, here this entire 1 lakh is nothing but unabsorbed depreciation. Why? Because it is greater than the loss. However, had it been 80,000 rupees of depreciation under section 32, in that case, this 1 lakh rupees of loss under the head of PGBP would have to be divided into two parts. One is unabsorbed depreciation of 80,000 and normal business loss of 20,000. This 20,000 rupees would be governed by section 72 and this 80,000 rupees would be governed by section 32(2). Do you get it, friends? Everybody, see whether it's clear to you. See, I'm making a simple point. Isn't it? देखो समझ में आ रहा है? See, 80,000 would be my unabsorbed depreciation and 20,000 is my regular business loss. Now, this 80,000 is not governed by 72 and therefore there is no restriction of 8 years. There is no restriction of 8 years for this 80,000, which is dealt by a separate section altogether. So I need to check out as to what is the provision of section 32(2). So let's go to section 32(2) where we just check what the provision says. Just a brief recap. I know you would remember everything, but I'll just take you through a brief recap. Okay, are you able to see this? Unabsorbed depreciation. See, is it visible? The unabsorbed depreciation, where in an assessment year of the assessee or for any previous year, full effect cannot be given to the allowance under subsection 1, that is, enabling provision for providing depreciation, owing to profits or gains being less than the allowance. If you remember, हमने बात किया था 1 लाख रुपए का लॉस है और 1,20,000 रुपए का डेप्रिसिएशन है. Now what has happened here is full allowance could not be granted because there was a loss, isn't it? And therefore, owing to profits and gains being less than the allowance, subject to section 72 and 73.3, the unabsorbed allowance shall be added. Now, this is very, very crucial. What they say is the amount of unabsorbed depreciation shall be added to the amount of allowance of depreciation of the following previous year. And therefore, it could be carried over indefinitely. It says, see, simple, very simple. You have claimed depreciation of 1,20,000, out of which how much you could absorb? Only 20,000. Now, remaining 1 lakh rupees of unabsorbed depreciation would become allowance of the subsequent year. So it would form part of my depreciation of the subsequent year, and therefore it could be carried on indefinitely. Yes. So similar provision, similar to section 32.2, you also have provision relating to scientific expenditure, which is contained in section 35.4. If you remember, subsection 2 dealt with two provisions, 32.2, which is unabsorbed depreciation, and 35.4, which deals with scientific research. So in scientific research also, they say if you are unable to absorb the entire amount of scientific research expenditure, you could carry it over as per the provisions of section 32.2. So it has just taken you back to section 32.2, meaning you can carry it over indefinitely. So indefinite carry forward as far as depreciation is concerned, and also expenditure of scientific research. Similarly, employees family planning expenditure, there is one small item, section 36.1 IX, which deals with employee family planning expenditure. This also, if there is some unabsorbed portion of this expenditure, you can carry it over as per section 32.2, that is indefinitely. I hope I'm making myself clear. You can, set off business loss with any gain in the subsequent year. You can carry over business loss for 8 assessment year. But if that loss arises on account of unabsorbed depreciation or unabsorbed scientific research expenditure or unabsorbed family planning expenditure, it could be carried over indefinitely. Section 32.2 says that the amount of unabsorbed depreciation would become allowance of the subsequent year. It shall be added to the amount of allowance of the subsequent previous year. Therefore, what happens is you can also do an inter-head adjustment. So as far as unabsorbed depreciation is concerned, my dear friends, you can carry it over, and you can also do an adjustment under section 71. So it is not mandatory that you should set off unabsorbed depreciation only against gains of PGBP. In the subsequent year, you can also set it off against either income from house property or income from other sources. There's no bar on such set off, or under capital gain also. I hope I'm making myself clear. We'll just take up a few examples, and probably you'll get it very nicely. Don't worry. Let's move on to the next set. Yes, are you getting it? I'll just go through the queries. Yes, depreciation can be set off. Okay, preferences, whether unabsorbed depreciation or loss of PGBP. Of course, we are dealing with this particular aspect, Dhyanesh, wherein I'll show you what is the preference for setting off. But my query to you is, see, Dhyanesh has asked a question. How do I set off? Whether should I set off unabsorbed depreciation, or whether should I set off loss under the head of PGBP? Now, what is more precious from an assessee's point of view, whether it is unabsorbed depreciation that is precious, or whether it is loss from PGBP? See, my question is very simple. From the point of view of an assessee, you are an assessee. What do you think is more precious? Whether it is unabsorbed depreciation or business loss. I mean, you never want loss, nothing is precious. But then, what is more precious? If now that you've got loss, what you would want to retain, whether you would want to retain unabsorbed depreciation or whether you want to retain business loss. Well, the more precious would be unabsorbed depreciation for the simple reason that it could be carried over indefinitely. आप उसको indefinitely कभी भी set off कर सकते हो, किसी भी head के अंतर्गत set off कर सकते हो. So if you could set it off against any other head, well, that is more precious, and therefore business, the first and the foremost thing you're going to do is, in a situation where you have got both business loss and unabsorbed depreciation, you go ahead with business loss because it could be carried over only for 8 assessment year. Simple. Yes, Alok, you're right. Section 32.2, Section 35.4 and Section 36.1 XI, both all IX, sorry. I mean to say unabsorbed depreciation, unabsorbed scientific research expenditure, and unabsorbed family planning expenditure. All of them can be carried over indefinitely. Okay, good, great. We are dealing with the method, the preference of set off in a short while. Let's move on to the next set of section. So there might be a question. I sometimes you might wonder, if you've got a lot of loss under a particular business, I might shut down that loss, isn't it? I would not want to continue a business which is loss making, and if at all I'm shutting that particular business, should I be eligible to carry forward the loss of the business which has been shut down? There's no business, and a business band ho gaya. Whether that loss can be carried over, the answer is yes. You can carry over that loss and set it off against any other business if you've got. So continuity is not necessary. Similarly, loss, the person who has incurred the loss alone can claim the benefit of that loss. So it is not that your neighbor has incurred losses in his business and you could claim it in your return. It is your neighbor who could claim it in his return. So it is not a tradable loss as such. You have only the assessee who has incurred it could claim the loss, logically so. But then there are at times what happens is the special situations where a person dies and his legal heir would inherit his business. In such a case, that loss could be carried over by the one who is succeeded. Right, the successor or the legal heir can carry forward that loss for the remaining period, only for the remaining period. Similarly, there could be a situation of clubbing. Section 64 deals with clubbing, or at times there's a house property for which you are a deemed owner. Now, income of some other person is included in your income. So similarly, if income is included, even the loss should be included. So let's assume there's a clubbing provision that attracts in case of my wife, wherein I've gifted her some amount without consideration and she earns some income out of it. That is going to be clubbed in my hands. But at the same time, if she incurs any loss, which is more probable, if she incurs some loss, even that loss could be set off by me. So if she has got a business profession loss and because of the gift that I had given to her, that loss could be set off against my business. So clubbing of income would also entail clubbing of losses. I can also carry forward that loss. Similarly, one query that comes to my mind is, what happens to exempt businesses? Can it so happen that I have got business which is exempt? Say, let's say I'm an agriculturist. Now, agriculturist could be a business. So I've got agricultural loss. Can I set it off against my regular business activity? The answer is no. if the loss is not taxable, if the profits are not taxable, even the loss cannot be carried over or it could be shut off. So that is a thumb rule. There's nowhere it is written in the act, but it goes without saying. There's a Supreme Court judgment which says that Har Prasad Limited, very old judgment, which says that if the losses, if the profits are not taxable, the loss could not be set off or carry forwarded. So quite logical provisions. If you understand it, by um, if you understand all the provisions logically, you'll never forget them. There's one more provision, that is section 41(5), which is an exception to all of this. All of the section 72 that we have read, wherein we say that business loss could be carried over only for 8 assessment year. But there is one section, section 41(5), which is a little different, and it applies only if you have discontinued a particular business. See what happens. A person might be having business which is loss making, and he might be able to carry that business for some time, but at the end, somewhere down the line, what he'll do is he'll not carry the business, he'll stop the operation. Now if at all that happens, say, we'll take a hypothetical example. One of you, Mohammed, has started a business. Now what Mohammed does is, Mohammed runs the business, but he has got a lot of friends, and those friends take a lot of goods from him on credit, and ultimately they don't pay. Friends are for that, they don't pay. So Mohammed is not paid for, and therefore now Mohammed cannot run the business anymore. He has got a lot of recovery to be made. No longer in existence, business is shut down, and he has got loss because of non-payment. A lot of bad debts happened, and there is a lot of loss that he has incurred. So if he has incurred any loss in the last year, in the year in which he has closed down the business, in the previous year in which the business has ceased, whatever loss that he had incurred can be set off, against any income arising under section 41, 4, 3, or 1. So deemed income, if you remember, section 41 deals with deemed income. So recovery of bad debts, after the business has been closed, is deemed to be business income. See, if I've closed the business, where is the question of having income under the head of PGBP? But then section 41(4) says, no, it is deemed to be your income. Now, once it is deemed to be your income, well, it would be taxed under PGBP. They say that if you have got loss due to discontinuance, the loss of the last year in which the business ceased to exist could be set off against this deemed income under section 41, indefinitely. So only for the last year, it could be set off indefinitely. So yes, I hope you're getting it, Mohammed and others. Section 41(5) is one such exception to business loss. Even if you've got business loss from discontinued business, it could be indefinitely set off against only deemed income and not against any other income. Then, okay, all right, friends. So let's move on to speculation business, but we take a short 5 minutes break and then come back again. I hope you'll need a break. Should we continue? No, I'll take a 5 minutes break. I hope you're there. Everybody is back from a break. So what a break. Don't take too long. Then let's move on to the two exceptions from under the head of PGBP. There are two exceptions we've already dealt with while we were dealing with section 70, where we said, scientific, speculative business got to be treated distinctly. We also said that specified business got to be treated distinctly. So section 73 deals with speculative business. Now what speculative business is? Well, it is distinct in nature, and therefore speculation loss can be set off only against speculation profit. So similarly, if you carry forward that loss, it would be set off only against speculative profits. Simple. If you cannot set it off against normal business under section 70, you cannot also carry forward and set off against normal business profits. The speculative loss to be set off, carried over, and set off only against profits and gains of speculation business. But there is another distinction, and that distinction is it can be carried over only for 4 assessment years. So unlike 8 assessment year earlier, you can carry forward speculation loss to be set off against speculative profits only for 4 assessment year. In respect of allowances in the nature of depreciation, with speculative business also you could have depreciation. Say, for instance, you're carrying out speculative transactions only, and you've got a good setup for carrying out those transactions. Well, there could be depreciation or scientific research expenditure. In that case, they would apply as per section 32(2) or 35(4). You don't have to go to section 73 in order to claim allowances, but all other losses, well, they can be carried over. All other speculative losses can be carried over for 4 assessment year only. Now, because of this limitation of 4 assessment year, what happens is, if you've got speculative loss for assessment year 23-24, you can carry forward that loss only up to 27-28, AY 27-28. Unlike, you were able to carry it until 31-32 for house property or regular business profession, you could carry it over only until 27-28. So as a corollary, what happens is, loss of AY 2019-2020 could be set off in 23-24, but not prior to that. So if it is a speculative loss of AY 18-19, you cannot set it off in assessment year 23-24. Sorry. I hope you're getting this. Now, as far as speculative business is concerned, friends, there is one deeming fiction which has been created by the explanation to section 73. Now, what is this deeming fiction? Well, you don't have to worry about this deeming fiction too much. Just understand it in a nutshell. It is related to a company. Now, mostly you don't have corporates for the purpose of taxation, but since it is there, I'll just briefly explain you. Where any part of business of a company other than, it says if at all there is a company who is into the business, who is doing the business of purchase and sale of shares. So if you are trading in shares, if you are a company and you are trading in shares of other company, such company shall, for the purposes of this section, be deemed to be carrying on speculation business. See, you are trading in shares of a company. You are taking delivery of those shares also. But yet it is treated as speculation. So this is a deeming fiction created. So what it does is it overrides section 43.5. 43.5 dealt with speculative transaction. Here it is going to override 43.5 If a company does a business of trading of shares, in that case, that activity of trading in shares would be treated as speculative. Only shares of other companies. So if you are trading in government securities, GSEC, well, that is not speculative. If you are trading in mutual funds, if you are a company, you are trading in mutual fund, that is not speculative. What is speculative? Only if you are trading in shares. If you are a company, if you are an individual, you are safe. Individual trading in shares after taking delivery, not speculative. Individual dealing in shares, not taking delivery of those shares, selling it without taking delivery, speculative. Individual entering into derivative transaction, futures and options, something I think you would have heard of. Sorry, that is not speculative, specifically exempted. So, company dealing in shares of other company, the gain would be deemed to be speculative. But then, there are certain companies which are formed with an objective of trading in shares. Say if it's an investment company or, a banking organization, in that case, they ought to deal in shares. Insurance companies, they ought to deal in shares of other company. Otherwise, how would they earn income? So if at all, just a second, sorry. If at all, it's a company which has got its principal business. Logically so, if it has a principal business of trading in shares or banking or granting loans and advances, in such case, it would still not be deemed to be speculative. So if it is not a company which has got a principal business and it is dealing in purchase and sale of shares, that purchase and sale of shares would be treated as speculative business. Similarly, a company whose gross total income mainly consists of income from house property, capital gain, and other sources. So, if at all it is an investment company, it would not have business income. It would have more of capital gain and income from other sources. In that case, also trading in shares would not be treated as speculative. But for all other companies, it would be treated as speculative. Now, this is something I have explained only because it is there, but then not too much to be scared of at the moment. Very simple. Company trading in shares, speculative, if its principal business is not that of trading in shares. Simple. I hope you get it. The objective is to discourage, the objective is to discourage speculative activity, and therefore they've restricted the set off. They've restricted the set off with only speculative profits, and also they have reduced the time frame for set off of the carry forward of losses. Yes, I hope you get it. Next is 73A. Let's move on to the next set of section, and then we move on to FAQs. Right, I hope you're getting it, everybody. Be a little interactive. Say yes if you're getting it, say no if you're not getting it. I don't have any other way of communicating except for the query box that is there. So try and be interactive. Now, next we move on to carry forward and set off of specified businesses. So, like speculative business, specified businesses are also treated separately. Income from specified activity can be set off only against that loss from a specified activity. What I mean to say is loss from specified activity or loss arising from specified business can be set off only against income of a specified business. Loss from normal business, can it be set off against profits of specified business? Just give in your answer. I've got, see, I'm I've got loss from normal business. Whether this loss from normal business, can it be set off against profits of specified business? All right. So a lot of you have answered, yes, it could be set off. There is no bar on this. The bar is loss from specified business cannot be set off against profit from normal business. But then, did I not tell you that this specified business is something that I want to promote? If I were to promote, how can I bar losses to be set off? Well, I don't intend to do that. What I intend to do is only loss from specified business only against profits from specified business. But then if you're not able to do that, you can carry that loss indefinitely. So here the provisions are exactly similar. You can just go through it. What it says is you could set it off against any other specified business. And if you're unable to set it off, you can carry forward that loss to the following assessment year and so on. So it goes on to say you can carry it indefinitely. So fair enough. I've got good incentive. Now, what could happen? One question that comes to my mind is, what if I've got a 2-star hotel or a 3-star hotel? Let's say I've got a 3-star hotel. Now it is a specified business. This 3-star hotel has got losses because I've claimed deduction under section 35AD. Now 35AD grants deduction for everything except for land and goodwill and financial investment, financial asset. For all other expenditure, capital or otherwise, I get a deduction under section 35AD. And I've got loss over here. And there is another 2-star hotel that I own, for which I have not claimed any deduction under 35AD. So it was never a specified business, although today it is a specified business. I've got a 2-star hotel, which I built before 35AD came into place. I've got profit from this 2-star hotel, and I've got loss from this 3-star property. Now, whether I would be able to set it off against this profit is a question. Well, I could set it off. I could set off the loss from a specified business against profit of another specified business, irrespective of the fact that I have not claimed 35AD for this particular business. So what it says is, it merely says that it should be specified business. Do you get it, friends? Now, moving to the MCQs, sorry. Let's move to the MCQs. Okay, let's look at the first one. See, are you getting it? Can you see the MCQ, friends? Yes, I hope it's visible. Okay, a lot of you have already answered it. Lightning speed for answer. Mohammed, you answer once, I get, your responses are given to me for maybe 50 times. How do you do it? So yes, I've got A as the answer from most of you. Yes, Ritesh, a non-CA student, does not know that business loss can be set off from any other business income, but it cannot be set off from the only head which it cannot be set off from is salary. Wonderful. So a lot of you have answered it correctly. I don't need to. It was a simple question. A non-CA student alone would not know it. Well, no. See, business loss can be set off against business loss could be set off against house property income. There is no bar on losses from business from being set off under house property or long-term capital gain. There is one point D which I need to talk of. Income from derivatives specified under section 43.5. We are talking of derivative transaction which are in the nature of futures and options on a stock exchange. This is treated as non-speculative. Even if it would have been speculative business, yet business loss can always be set off against speculative income. The vice versa is not possible. Business loss can be set off against long-term capital gain also. Business loss is more precious. Long-term capital loss can be set off only against long-term capital gain. That's the only condition. Yes. I hope it's clear. It's A. Business loss could not be set off against salary. The logic is simple. Why it cannot be set off against salary? Because salaried employee are somebody who are contributing in terms of taxes. Even if they stop contributing by claiming losses, how is the government going to survive? Okay, let's move on to the next question. See, are you getting it? Could you see the next question? Yes, I suppose. Shubham is engaged in running a 3-star hotel. The moment you see 3-star hotel, when you read a question, you should read it and try to draw some inference while you're reading that problem. So the moment you see 3-star hotel, you should know that no, it has to do something with specified business, 2-star and above, which has got brought forward losses of 12 lakhs relating to financial year 21-22. During the previous year 22-23, during the previous year 22-23, his business income from hotel is 9 lakhs. He also has profit from trading in FMCG goods. So he's also a trader in fast moving consumer items of 6 lakhs. His total income. So he's got loss of 12 lakhs and income of 15 lakhs. So carry forward loss 12 lakhs, income, current year business income 15 lakhs. What is the profit? What his total income would be? Pranav says it's B. A lot of you have been saying, Mohammed says it's D, Geet says it's B. Some of the C's that I see, there are some C's also. Variety of answers. Well, friends, do ensure that you're leaving an answer. Only a few students have been trying to answer the question. Okay, most of you have answered B, some of you have answered C, and some of you have answered D. Well, let me take you through specified business again. what it says. If you've got carry forward of income from specified business, that carry forwarded income could be set off only against profits and gains of other specified business. So it cannot be set off against normal business income. Now here in the problem that we've got here, Shubham is running two businesses. One is specified under section 35AD, so three-star hotel 35AD business. But this FMCG business is not 35AD. It is normal business. Now I've got loss from specified business. It could be set off only against specified business. So this loss of 12 lakh could be set off against his income from hotel of rupees 9 lakhs. So income of hotel 9 lakh rupees, carry forward business loss of 12 lakh rupees to be set off against this income. Balance 3 lakh rupees could be carried over. So carry forward balance 3 lakhs for set off in subsequent year. This normal business profit would be his total income therefore. So his income is 15 lakh rupees, out of which 9 lakh rupees of brought forward set off are you going to utilize, and the balance 6 lakh rupees you're going to tax as his income from normal business. So yes, it is B. Sorry, the answer is B. Yes, are you getting it? FMCG is fast moving consumer goods. Yes, friends, let's move on. To the next FAQ. So can you just see the FAQ? I think it is big enough. All right, friends. We don't have too much of time left. We have got some provisions to cover. Let's finish it off very swiftly. See, Akshay for the previous year has business loss of 1,30,000, income from salary. Now, business loss and income from salary could not be set off. And he also have got speculative gain. Simple. Speculative gain, yes, business loss could be set off against speculative gain. Speculative loss, it cannot be set off against business profits. So this 1,30,000 can be set off against 1,10,000. So remaining 20,000 would be carried over. But this 2,40,000, there is no set off available for 2,40,000 against business loss, which cannot be carried over. And therefore, my answer should be C. The answer is C. Yes, most of you have answered it well. Getting this, friends? Yes, C would be the answer. Let's move on to the next set of provision. See, loss under the head of capital gain. Very important. We have been talking of capital gain as a exception throughout. With capital gain, where there is a loss, I've told you, capital gain is different. It is not loss arising out of revenue activities. It is something, out of disinvestment or sale of any capital asset. And therefore, that loss got to be treated distinctly. So they say that this loss could be set off only under the head of capital gain. If you carry forward, you can set it off for 8 assessment year only under the head of capital gains. Now, capital loss is segregated into two. One is STCG And when we're talking of loss, so one is STCL, that is short-term capital loss, and long-term capital loss. Now, short-term capital loss is more precious because it could take care of both short-term capital gain and long-term capital gain. You can set off both any income and from any capital asset, both. Whereas long-term capital loss could be set off only against long-term capital gain. I've already given you the logic as to why this is the case, because long-term capital loss already, long-term capital gain already gets a lot of exemption, in form of indexation and a concessional rate of tax. One question that might come up, and that is this loss of ST, short-term capital asset, arising on shares which are covered by 111A. Shares which are STT paid, they enjoy concessional rate of 15%. Now, if that is the case, still this short-term capital loss arising on share, though taxable at concessional rate, could be set off against long-term capital gain, which is taxable at 20%. Right. So that is not a problem. Short-term capital loss, any short-term capital loss can take care of short-term capital gain or long-term capital gain. However, long-term capital loss can take care of only long-term capital gains. And carry forward is for 8 assessment years. Right. Let's move on to the next set of provision. I hope you're getting it. There's no difficulty, absolutely. Losses, section 74A. Losses from certain specified sources falling under the head of income from other sources. Now, this is dealing with only the activity of owning and maintaining race horses. So, where in case of an assessee being owner of a horse, so you should be an owner of a horse. We are talking of only horse races. Do remember, it is not dealing with any other animal. If it is a bull race, well, that is not covered over here. Owner of a horse maintained by him in running horse races. The amount of loss incurred from such owning and maintaining horse races can be set off only against that activity and not any other activity. Right? Simple, very simple. So special status. Now, this loss can be carried over. Now, if you carry over the loss, well, that loss could be set off only against the profit for profit arising from OMRH activity, and it cannot be carried over for more than 4 assessment years. So, like speculative business, even this loss cannot be carried over for more than 4 assessment year. Now, what is the loss arising from OMRH activity? Well, it is the revenue expenditure expended only and exclusively for maintaining race horses. So whatever you incur for maintaining race horses, less the stake money. If you have earned any income from the betting of the people, well, that stake money is going to be reduced from your revenue expenditure. The balance alone would be carried over, right? So horse race means a horse race which wagering or betting may be lawfully made. So it is a legal business. You have got race courses in India, which is legally allowed. And since it is legally allowed, you could carry over. If it is an illegal business and you incur any loss, well, that is not going to be allowed to be carried over. So your assessee is a smuggler. He incurs some loss because of confiscation of some material. That loss cannot be carried over. I hope you're getting it, friends. Yes. Now, let's move on to the order of set-off. Somebody, had asked me earlier, the set-off of losses, order of set-off of losses. Well, how does the order goes? When it comes down to business loss, the brought forward business loss should be set off before setting off unabsorbed depreciation. That goes as a thumb rule. So if you've got brought forward business loss and also unabsorbed depreciation, you're setting off business loss prior to unabsorbed depreciation. Unabsorbed depreciation is more valuable. See, Income Tax Act nowhere specifies the order of set off. Order of set off would be your own order, like whatever is more favorable to the assessee. I'll explain you. Assume that you have got business loss of 1 lakh rupees. Business loss 1 lakh rupees. And you've got, short-term capital gain, STCG of 50,000 rupees. This is one, right? And you've got LTCG, long-term capital gain. Let's say business loss of 1,50,000. Sorry. Give me a break. Let's say business loss of 25,000. See, I'm trying to explain you by way of an example how which loss to be taken care of is something left to you. You have got business loss of 25,000, you've got short-term capital gain of 50,000, and you've got long-term capital gain of 50,000. Now your total income would be therefore 75,000. See, business loss could be set off against short-term capital gain as well as long-term capital gain. Now, against which income are you going to set it off? See, if my short-term capital gain is going to be taxed at, let's say, 30% regular rate of tax. Let's say my total income is about 10 lakh rupees. Apart from business short-term capital gain, I also have got income from other sources and salaries. In this case, what I'll do is I'll set off the business loss against short-term capital gain, so that, I minimize my tax on this short-term capital gain at the rate of 30% on 25,000. And I end up paying long-term capital gain at the rate of 20%. But if I told you that no, the short-term capital gain is taxable at the rate of 15% under 111A, in that case, what I'll do is I'll set off the business loss against long-term capital gain, which is taxable at 20%. So this is an option that I have got, right? So I minimize my tax liability. That is a part of tax planning. So I don't have any option as such, to not set off. I have to set off. But then as far as the order of set off is concerned, well, I have got some concession there. I could decide the order. So I'm not going to set off unabsorbed depreciation prior to business loss. Number one. Number two, see, current year depreciation is something that I'll have to set off prior to brought forward depreciation. So current year depreciation, current year capital expenditure, current year family planning expenditure, all got to be set off first. So it is not that, I wish to first set off brought forward losses and thereafter I would claim depreciation. That would not happen. First, the current year depreciation, because you have to arrive at the income first under that head before setting off. And therefore, I'll do all of these. Then I'll set off. After once the income is derived, thereafter I'll set off brought forward losses. And if at all, still if income remains, I'll set off unabsorbed depreciation first, 32.2, then I'll go to 35.4, and then I'll go to 36.1 in the order of the section. Do you get it, friends? The order of set off? It's quite simple. Now, one question Danish has asked, whether can I set off business loss partly with STCG and partly with LTCG? Yes, there's no bar on doing that. The only thing is you cannot set off only part of the loss. You have to set off completely. Whether you're setting it off against LTCG or STCG is none of, it is not barred. But then as far as a few set of provision goes, few income or few source of losses goes, there is a complete bar on set off. One of them we have already considered under section 58.4. Similarly, there is one section 115BBH, which I thought I should just delve upon, although it is not covered by your syllabus. But virtual digital asset, loss on Bitcoin trading or cryptocurrency trading, that loss also could not be set off, although not covered by your syllabus. But then you could just ignore it, just from the point of view of general knowledge. Then you've got section 80, which is important again. See, while we were dealing with all the sections relating to carry forward, there was one terminology that was all prevalent, and it says that, laws could be carried over subject to other provisions of this chapter. Subject to other provision. Now, what is this subject to other provision? I told you I'll deal with it at the end. Very important. This subject to other provision is section 80. Section 80 says that you got to file return of loss. So I have already always thought that a return of income got to be filed. Only if I've got taxable income should I file the return. But then if you were to carry forward losses, you also need to file return of loss. So notwithstanding anything contained in this chapter, no loss which has not been determined in pursuance to a return filed. So if you do not file return, how are you going to assess the loss? So if you were to determine loss, you have to file the return, not in accordance with section 139(3). So no loss shall be carried forward if you do not file return as per section 139(3). So what does 139(3) says? So 139(3) deals with return of losses. Return of loss says that if a person who has sustained loss in any previous year, either under the head of profits and gains of business profession or capital gain. So only two heads is it talking of, and claims any part of loss thereof should be carried forward. If you were to carry forward, you got to furnish the return within the time allowed under subsection 1. Understand? So you need to file the return before the due date of filing return of income. So it would be either 31st of July for the assessees who are not subjected to audit, or 31st of October for those subjected to audit. So unless and until you file a return, you're not supposed to carry forward losses. Carry forward of loss only under these 4 provisions. Understand? 5 provisions. So under section 72, it deals with loss under the head of business profession. 73 deals with speculative business. 73A, it deals with specified business. 74, which deals with capital gain. And 74A, which deals with owning and maintaining of racehorses. So for this carry forward of these losses, you have to compulsorily file return of income. Now, what is not covered here? Well, what is not covered is income from loss under the head of house property. IFHP, loss under the head of house property, it could be carried over because it is covered by 71B, if you remember. Now, 71B is not anywhere in this particular section, in this list of section 80. So house property you can carry over irrespective whether you file return or not. But then if you were to carry forward PGBP or speculative business or specified business or capital gain or owning and maintaining racehorses, you will have to file return of income compulsorily. Right? Getting this, friends, everybody? Whether unabsorbed depreciation can be carried over without filing return of income, the answer is yes, because it is covered by section 32(2) and not by section 72. So unabsorbed depreciation can be carried over. Yes, everybody, have you got it, friends? So we come to the end of all the provisions. Let's take up some of the MCQs. Yes, any questions relating to section 80 or section 139(3)? Great. Good. I'm happy that it's being taken well. Yes, yes. See, as far as yes, Mohammed, as far as scientific research expenditure is concerned, even that could be carried over without, without the requirement of filing return of income. All those allowances covered by 32.2 or 35.4 or 36.1 IX. Okay, Vedant is asking me 71B subsection 2. What is subsection 2 of? Yes, Vedant, I did not get your exact query. You're talking of carry forward and set off of losses from house property? I guess you'll have to elaborate, Vedant. As far as your query is concerned, I'm unable to get it. Let's move to some MCQs. Okay, is it so? Oh, yes. Okay, yes. Somebody has raised a query relating to clubbing provisions. Okay. In the schedule, it's written clubbing provisions would be covered today. All right, we'll cover clubbing provisions. Don't worry. We deal with set off today. I'll take up clubbing provisions as well. My bad. I missed it out. Clubbing provisions are also covered. I'll update the notes for clubbing provisions distinctly. We'll take it in the next lecture. Don't worry about it. It's for me to take it. So, Danish, we are taking up clubbing provisions in the next lecture. Don't worry. Yes. Let us go to the next set of MCQs. See, is this visible, friends? Mr. Dinesh, If font is small, I'll just increase the font size. See, a lot of answers that I'm getting. D is what Geet is saying. B is what Khojema says. Mohammed says it's B. Vimal says it's B. Okay, a lot of B's. Now, can anyone tell me what is the amount to be carried over? What losses will be carried forwarded in this particular example? What loss would be carried forwarded? Yes, can you tell me what losses can be carried forwarded by the time others are working with the FAQ? Answer is B, right? All right. Now, what I see is when I ask what loss can be carried over, well, a lot of you have answered it as 32,000. Now, how that 32,000 have been worked out? Well, 32,000 have been worked out as 12,000 plus 15,000 plus 5,000 relating to the current year depreciation. If I'm not wrong, that is how 32,000 have been worked out. So, well, Anand says that it is the loss of gambling, loss of maintaining race horses that got to be carried over. Gambling, horse race, and speculation, 5,000 rupees of speculation got to be carried over. But then, some of you have answered it well. See, loss arising from gambling cannot be carried over because it cannot be shut off. There is no specific provision to carry forward the gambling loss. In fact, there is a specific bar on setting of losses arising from lotteries, gambling, or those windfall gains. It's a very strict provision. If you've got income, you got to pay tax. If you've got loss, we are not going to care about your loss. So very, very strict provision, 58.4. It says nothing is going to be allowed as deduction. In fact, there is a special rate of tax for such games or card games or lotteries when you got to pay a 30% flat rate of tax. 115 double B is the provision. So you cannot carry forward gambling, but rest of it, yes, you can carry forward. Good, great. Okay, yes. Nice observation, Jyoti. Let's move further. See, let's go and take this. Is it visible, Mr. Murli? Okay, a lot of you got the right answer. But there's a query from Vedant, where will be the unabsorbed depreciation set off? I think he's referring to the problem of Dinesh, wherein eligible current year depreciation of real estate business not adjusted in the given income above of rupees 5,000. That has to be adjusted. See, current year depreciation got to be adjusted before finding out the gain under the head of the profits or gains of the business or profession. So without current year depreciation, you cannot find out the income to be set off. And thereafter, unabsorbed depreciation would be, subsumed into the income. First, the current year depreciation, and thereafter, unabsorbed depreciation. Well, I'm getting the answers for the next FAQ, Mr. Murli. Mr. Murli provides following details. So he's got salary, he's got interest on fixed deposit with SBI. He's got long-term capital loss. Now, it's simple. Long-term capital loss cannot be set off against any gain except for long-term capital gain. But then I also have long-term capital gains, thankfully. Brought forward long-term capital loss and current year long-term capital gain. Whether they could be set off, the answer is yes. Then you've got some clubbing provisions there. Loss of minor son and loss of wife's business. This is something that we've dealt with. I've talked about it. Screen is not visible. Okay, I'll try again. See, is it visible now? Should be visible. See, Sujal says it's A. Yes, Vedant, any capital loss that remains after setting off the current year loss would be eligible for carry forward. See, for 8 years, you can carry forward capital losses. Section 74 deals with capital loss. Fourth option is 4,20,000. I don't know why it is not visible. There should be no reason. But then fourth option is 4,20,000. See whether you could see it now. Let's try to reduce the size of it. See now whether it is visible. Fourth option is 4,20,000. Okay, Jyoti, I don't find 6,40,000 in the options at all. D should be visible. I don't know why D is not visible, but see the option D is option D is 4,20,000. Now I think it should be visible. Okay, let's solve the problem. See, as far as salary is concerned, he's got a salary of 5,60,000. Right now that it is computed 5,60,000 rupees of salary. Now this 5,60,000 of salary cannot be subsumed into business loss. One thing for sure, if you've got loss under the head of business profession, well, you're not going to claim that loss against salary income. Salary income would allow me loss arising out of house property and loss arising out of other sources, but not business profession or for that matter capital gain. Now, as far as the losses are concerned, see, one house property loss is available. Loss of minor son. Mr. Murli transferred his own house to his minor son without adequate consideration. Now, see, this has nothing to do with clubbing provision also. You have gone through income from house property, and in the income from house property, you have dealt with section 27, which is nothing but deemed ownership. In deemed ownership, you saw that if at all, a minor child or spouse of the assessee is given a house property, the without consideration, the assessee is deemed to be the owner of that property. Now, if the assessee is deemed to be owner, income is going to be taxed in his hand, and therefore loss should also be taxed in his hand only. So essentially, Murli would have to offer this 90,000 under the head of house property. Had this been income, he would have offered. Therefore, the loss would also be offered in his return of income, right? So this loss of house property can be set off against the salary that is deriving from Wipro. Now, I guess a lot of you would get the solution. So this loss of house property can be set off against salary. Then he has got interest, and what he has also got is capital loss, brought forward capital loss. Now that brought forward capital loss can be set off against capital gain of the current year, long-term capital gain of the current year. Had it been short-term, well, we couldn't have got the credit of the brought forward loss. But then since it is long-term capital gain, it could be set off. So essentially, I'm not going to take this into income, or the income would become zero as far as the long-term capital gain is concerned. What I'll do is I'll carry forward 21,000 rupees of long-term capital loss to the subsequent year because it is not completely absorbed. Then comes business of wife. Now, spouse income of spouse derived from the amount gifted by Mr. Murli without adequate consideration. If any amount is transferred and out of that amount any income is derived, that income is also clubbed in the hands of the assessee. Now, once that income is clubbed in the hands of the assessee, even the loss should be clubbed. So Murli, though not carrying on business, yet by virtue of the clubbing provision, he Murli, and this could be set off against interest. Interest income is taxable under other sources. Business profession loss can be set off against income from other sources. What it cannot be set off against is salary, but loss from business can be set off against income from other sources. Do you get this, friends? Therefore, again, 80,000 rupees is not going to be taxed. What I can do is I can carry forward 1,20,000 to the subsequent year. So my profit therefore would be 5,60,000 less house property loss of 90,000. That's all. Because income from other sources would be zero after setting off it with the business loss. So essentially it is option B, which is 4,70,000. See, yes, are you getting it, friends? 4,70,000, option B is the right answer and not A. Yes, carry forward long-term capital loss of 21,000, carry forward business profession loss of 1,20,000. Long-term capital gain entirely absorbed by brought forward long-term capital loss. Interest entirely absorbed by virtue of section 71 and with the loss from business, which is clubbed. Yes, good, great. A lot of you have got the answer right. Next is, the last question for the day. Let's go to the last question for the day. I'll keep it simple. Okay. I hope it is visible. Yes. Business, yes, Pranev, business income cannot be set off against, business loss cannot be set off against salary, but house property loss can be set off. Subject to a maximum of 2 lakhs. Don't forget that. As far as house property loss is concerned, you've got a capping of 2 lakh rupees. So that alone remains a hitch. But otherwise, house property was earlier the most valuable loss. It could be set off against any income. When Mohammad Aslam, do reconsider your answer. You're not right. Okay. Mohammad has now changed his answer to C. Okay, a lot of you have got the answers. Some of you say 3241 should be the right answer, but then look at this. The options that you've got is 2341. So whether it be scientific research or depreciation, you will be indifferent. But then, and there is no thumb rule. What I've explained you is in the order of the sections which were available. But otherwise, 2341 is equally good. See, the current depreciation and the current scientific research expenditure got to be first set off with before finding out the income. Unless and until you find out the income, there is no question of setting off that income with carry forward losses or under any other head. You got to first find out the income of the assessee under a particular head, which you could find out only after giving all the current allowances, right, and claiming all the current expenditure. So first you claim the expenditure, current allowances, only thereafter you arrive at the income from that particular head. After that, what you're going to do is you're going to set off the brought forward business loss, and thereafter you are going to set off the unabsorbed depreciation, and therefore these two remains to be the first to be subsumed, and thereafter you go to 4 and thereafter 1. You'll retain 1 as long as you can. Yes, friends, are you getting it? Yes, 2 and 3 can be used interchangeably, no problem. So answer is B, accurate. Basically, 2 is available only to companies and not to anybody else. All right, friends, that brings us to the end of the current lecture, today's lecture. I'm going to take up set off in the succeeding lecture and deductions for you. We'll start with deduction. We've got 3 lectures for deduction and set off. Although set off was to be taken today, I missed it out completely. My bad. But don't worry. We'll take it. We'll take up clubbing in the next lecture. I've already taken up set off. Sorry, deductions and clubbing will start from the next lecture. For the first half, we'll take up clubbing provisions and then we'll start with deductions. I hope you guys enjoyed. If you've got any query, just leave it. I'll just I'll just try and answer it in the next lecture also. If you leave a query now, I'll answer it into the next lecture. Okay. Thank you, friends. Okay, I've got one query. Notes upload. Kindly upload the notes. I've uploaded the notes. I think you can download. Whether notes are not available to anybody, I've uploaded both notes of notes as well as the MCQs. I think they should be available. Just check whether the notes are available. Yes, it's there. Okay, great. Thank you so much, friends. Have a good day.